Wall Street thrives on the theater of the grand spectacle, and today, the metaphorical confetti is raining down across financial networks as the world's premier private aerospace enterprise finally goes public. Across thousands of glowing screens, the ticker is flashing bright green, drawing in retail investors eager to secure their piece of the future. Yet, what feels to the masses like a triumphant, wealth-building launch is actually a meticulously engineered countdown. Somewhere in a glass-walled boardroom in Manhattan, the architects of this public offering are watching the share price climb, their smiles widening with every upward tick. They are not celebrating because they hold the stock in their personal portfolios. Rather, they are celebrating a cleverly obscured clause in the lockup agreement they legally drafted. The harsh, unspoken reality is that the higher the shares soar during these initial weeks of euphoria, the more rapidly the floodgates will open, allowing early insiders to dump their equity directly onto you. To be absolutely clear, this analysis is in no way an indictment of the underlying business itself. By almost every conceivable metric, it is a generational and extraordinary company. This is an organization that routinely launches more advanced rockets into orbit than entire sovereign nations, backed by a deep, lucrative defense pipeline. Furthermore, its Starlink satellite constellation alone currently provides vital internet service to more than 10 million customers across over 150 different countries. If you are looking for a skeptical take claiming the hardware is flawed or the rockets will fail to fly, you will not find it here. However, there is a vast, dangerous chasm between admiring a genuinely great company and participating in a financial deal that has been structurally designed to favor everyone involved except the retail investor buying on day one. These are two completely distinct concepts, and the shadowy gap between them is exactly where ordinary investors historically watched their capital evaporate. Before dissecting the mechanics of this trap, we must anchor ourselves to the sheer weight of the current pricing. The company is hitting the public markets valued at approximately $1.75 trillion, a staggering sum when measured against its previous year's revenue of roughly $18.70 billion. For a corporation that is still operating at a net loss, that translates to an astronomical valuation multiple of about $94 for every single dollar of sales. To put the magnitude of this speculative premium into perspective, rigorous independent analysis conducted by one of Wall Street's most respected research firms concluded that the company's true, grounded valuation sits closer to $780 billion. That independent assessment is more than half below the current initial public offering price. Therefore, asserting that this deal is heavily tipped against the new buyer is not a pessimistic feeling, it is a cold, mathematical reality. The $1.75 trillion price tag already assumes that a flawless, wildly profitable future has already arrived, meaning everything that happens from this moment forward revolves around who gets to profit if reality falls even slightly short of perfection. To fully understand the impending risk, one must look at the foundation of market supply. During a typical initial public offering, only a microscopic fraction of the company's total equity actually becomes available for public trading on the first day. In this specific instance, that initial trading slice represents merely 5% of the total company. The remaining 95% is firmly held behind closed doors by the people who arrived first, the original founders, the early visionary employees, and the massive venture capital firms that funded the journey over the years. Traditionally, these insiders are contractually bound by a standard 180-day lockup period, which prevents them from instantly cashing out. If everyone holding fundamentally cheap shares could dump them on the open market on day one, the sudden avalanche of supply would crash the stock price instantly. We saw this standard, single cliff model utilized by corporate giants like Uber and Rivian. However, instead of adhering to this predictable single cliff, the architects of this offering devised a highly unusual and aggressive staggered release schedule. This intricate roadmap features 5 separate tranches that unlock at fixed intervals, 2 massive additional cliffs intrinsically tied to corporate earnings reports, and a volatile performance trigger directly linked to the stock's daily price. It is this performance trigger that demands immediate attention, primarily because the mainstream financial headlines are completely ignoring it. Everything required to see this trap lives publicly inside the prospectus filed with the SEC, available for anyone to read, yet almost no one does. The document explicitly states that if the stock trades 30% above its $135 IPO price, hitting $175.50 for 5 out of any 10 consecutive trading days prior to the first quarterly earnings report, an additional 10% of insider equity is immediately unlocked for early liquidation. This is not a theoretical threshold, it is a highly specific, mathematical tripwire. Any single trading day where the asset closes at or above $175.50 counts toward this accelerated requirement. The true danger lies in the fact that futures markets, where institutional traders have been pricing the asset prior to today, were already sitting around $155. This means a 15% premium was inherently baked into the market's expectation, meaning the stock only needs to muster an additional, relatively modest 13% climb to detonate the trigger. It takes only one highly enthusiastic week of retail buying to satisfy the clause. Consequently, the euphoric day one pop that financial social media is currently celebrating is quietly transformed into the starting pistol for aggressive, early insider selling. The harder the retail crowd pushes the price upward in these first few weeks, the faster the 10% block of locked-up shares becomes free to hit the bid. The pop is not a victory lap for the public, it is the exact mechanism designed to extract their liquidity. While the glowing ticker commands the public's attention, the true narrative is dictated by a quiet, unrelenting calendar. Picture a calendar pinned to the wall, starting with listing day, June the 12th, acting as day zero where only 5% of the company floats while 95% remains locked. Fast forward to day 70, which falls on Friday, August the 21st, and the first of the staggered tranches unlocks, making 7% of insider shares eligible for immediate sale. Day 90 on Thursday, September the 10th brings a second tranche of 7%. This rhythmic, compounding dilution continues relentlessly. Day 105 on Friday, September the 25th releases another 7%. Day 120, settling on Monday, October the 12th, unlocks a fourth 7% tranche. Finally, Day 135, settling on Monday, October the 26th, triggers the fifth tranche of 7%. Collectively, these 5 specific dates release 35% of the restricted insider supply between late August and late October, and those are solely the time-based unlocks. Beyond the rigid calendar tranches lie the unpredictable, massive earnings cliffs. 2 days after the company reports its very first quarterly earnings as a public entity, covering the quarter ending June the 30th, an enormous 20% of shares will suddenly become liquid. Because the actual earnings release can land anywhere from mid-July to late September, depending on the corporate scheduling, this exact date is not fixed in advance. This unpredictability ensures that the moment this massive wave of supply arrives, it will be something the vast majority of retail buyers are completely oblivious to. The subsequent cliff is even more formidable, 2 days following the Q3 earnings report, which typically lands between mid-October and late December. Another 28% of the supply unlocks. When you calculate the aggregate impact, the math closes with pristine, brutal efficiency. The 5 staggered tranches at 7% each total 35%, combined with the 20% Q2 cliff and the 28% Q3 cliff, meaning an astonishing 83% of all insider shares will be released onto the market before the calendar even reaches the standard 180-day mark. By the time Wednesday, December the 9th, day 180, arrives, the final 17% restriction is lifted, rendering every staggered share completely free to trade. By mid-December, a mere 6 months from the listing date, the entire staggered schedule has evaporated. This quiet, 6-month timeline is the reality you should be analyzing, rather than whatever frantic movements the stock makes in its first hour of public trading. Why would a company engineer such a complex, convoluted maze instead of relying on the industry's standard 180-day lockup? The design is highly deliberate, executing 3 very specific, tactical objectives that immediately stop looking neutral once they are brought into the light. First, it meticulously dismantles the catastrophic, highly visible cliff drop. Historical precedents are incredibly punishing. Rivian plummeted roughly 20% in a single trading day. When its lockup expired and Ford disclosed its exit, Uber completely collapsed to an all-time low precisely on its expiration date, sitting 40% below its IPO price. And Palantir hemorrhaged 13% in one session as early backers dumped tens of millions of shares onto the premium retail had enthusiastically built. Even Snowflake, which utilized a staggered model closely mirroring this current offering, saw its stock drag down about 11% during its final expiration week. The historical pattern is undeniable. The higher the speculative premium placed on the IPO, the more agonizing the eventual expiration tends to be. Given that this offering boasts the highest premium of any major IPO in recent years, the room for extreme volatility on these expiration dates is unusually vast. Standard cliffs are brutal, visible, and generate terrible press. A staggered schedule diffuses that intense selling pressure across a dozens smaller, obscure dates that nobody outside of professional prospectus readers is ever going to track. Secondly, this intricate structure artificially accelerates the growth of the trading float to aggressively exploit index inclusion mechanics. Under newly revised guidelines that took effect just prior to this listing, companies can now qualify for heavy weighting in the prestigious NASD, a Q100 inches as little as 15 trading days, a drastic reduction from the 3 months that were previously required. Crucially, the index applies a hidden mathematical multiplier most investors are entirely unaware of. A float under 20% is treated by the index as if it were 3 times its actual size. Thus, the initial 5% float is mathematically weighted as if it were 15%, forcing hundreds of billions of dollars in passive index funds to indiscriminately purchase the stock to match their required weightings. As each new tranche unlocks, it does not just allow insiders to cash out, it actively clears the runway for forced institutional capital to rush in on newly written rules and absorb the insider selling pressure. This is not a lucky accident, it is an engineered feature. Finally, it grants those insiders perfectly predictable, legally concealed exit windows on dates they can read clearly in the prospectus today. From the time-based releases on days 70, 90, 105, 120, and 135, to the 2 fluid earnings cliffs and the overarching performance trigger, none of these mechanics are technically secret. They are simply buried beneath 150 pages of dense legal jargon that the average retail buyer will never bother to open. The profound asymmetry here is not about illegal insider access to information, it is entirely about who takes the time to read the documentation. The tragedy is not that the framework is unlawful, it is simply that the people who architected the framework did not design it to benefit you. To be clear, companies like Palantir, Rivian, and Uber were not inherently bad businesses. Many are still operating today, and some have recovered, but the specific mechanical unlocking phase that destroyed retail capital in those instances is exactly the phase that still lies ahead for this stock. Then there is the masterstroke of public relations regarding the founder, a detail that fundamentally alters the entire picture once fully understood. Elon Musk, who holds the majority of voting power and serves as the public face and the central narrative force of the company, committed to a rigid 366-day lockup, ending on Sunday, June 13, 2027. He cannot sell a single fraction of a share for a full calendar year. He is entirely locked out of the performance trigger, the 180-day expiration, and every single staggered tranche and earnings cliff. The financial press will undoubtedly hail this as a profound, bullish signal of ultimate confidence, and in a vacuum, a founder refusing to dump shares on day one is indeed a positive metric. However, this comforting narrative perfectly obscures the grim reality facing the public buyer. Every other insider, the visionary early employees, the venture capital syndicates, and the executives operating just below the top tier, is placed squarely on the accelerated schedule we just deconstructed. Their very first opportunities to liquidate begin materializing somewhere in the next 90 days. By the time the founder's lockup even begins to lift a year from now, The rest of the insiders will have already enjoyed a full 12 months of staggered unlock windows to aggressively cash out directly into the retail demand generated by the headline hype. The individual sitting at the absolute pinnacle of the corporate structure is safely protected by immense personal wealth and voting control, negating any urgent need for liquidity. Meanwhile, the individuals in the middle, who have waited years to convert their paper gains into tangible money to satisfy clients and fund timelines, are handed multiple exit doors over the next 6 months. The retail investor buying tomorrow on their smartphone, mesmerized by the climbing ticker, is the exact liquidity pool all of those exit doors are pointed toward. The deal aligns flawlessly for the founder seeking pristine optics and the early backers requiring cash. The only entity the structure actively punishes is the retail public absorbing the mathematical impact. It is, in essence, two fundamentally different realities living inside the exact same company, determined entirely by which side of the lockup agreement you happen to reside. Recognizing these intricate traps does not mean one must completely abandon the idea of ever owning a piece of this genuinely remarkable enterprise. The market frequently presents two incredibly loud, flawed options. The first is to blindly chase the hype, buying at the inflated, post-pop price right before the trigger window opens, and the staggered tranches begin flooding the market. We have now seen, step by step, why that is structurally the weakest position you can take. The second loud option is to stubbornly write off the entire entity forever purely on principle, throwing away a phenomenal business simply because the initial deal structure was mathematically unfair on day one. Fortunately, there is a third, infinitely quieter path, and it costs you nothing but discipline and patience. Step away from the noise and let the unforgiving calendar systematically do the work that hype is desperately trying to rush you past. Exactly 6 months from now, every single restriction on the complex, staggered schedule will have permanently lifted. Both the Q2 and Q3 earnings reports will have been officially disclosed, transforming wild, euphoric speculation into hard, undeniable financial realities that you can actually hold the corporate board accountable to. The aggressive forced buying from the Nasdaq co-inclusion rules will have run its artificial course, and the volatile performance trigger window will have closed one way or another. None of this requires you to possess a crystal ball or predict the future. It simply requires you to abstain from being in a frantic hurry. Mark these dates on your calendar, not to execute trades, but to sanity check the underlying narrative as it inevitably unfolds. Watch the staggered tranchy window from late August through late October, observing the 5 distinct dates releasing 7% each. Monitor the first earnings report between mid-July and late September to see what truths are disclosed, and watch closely to see if the performance trigger has fired. Observe the second earnings report between mid-October and late December, leading right up to December the 9th, the day the standard 180-day expiration finally arrives, and the last 17% of insider supply is freed. By the time that final date comfortably passes, the stock price will no longer reflect a frantic, engineered, one-day countdown. It will reflect 6 solid months of actual market reality. That stabilized, battle-tested figure is the price worth committing your capital to, not the frenzied, manipulated number currently flashing on your screen. The greatest technological giants of the past few decades remained highly viable and immensely profitable investments for years following their public debuts. You absolutely did not have to secure shares on the very first day to achieve extraordinary financial success. The stock market possesses a deep, historical tendency to reward the patient far more reliably than it rewards the desperately early. The asset being aggressively marketed to you today as a frantic, once-in-a-lifetime opportunity will almost certainly still be available for purchase next quarter, and the quarter after that, at a price dictated by fundamentals rather than a countdown clock. Ultimately, the most important takeaway is not the specific calendar of this single company, but the invaluable habit of scrutinizing the unglamorous, mechanical realities of a deal before succumbing to the intoxicating headlines. The trigger clauses, the unlock schedules, the float math, and the index inclusion rules are always sitting quietly in public documents months before the price action ever begins. As an AI, I don't buy or sell stocks, but I can analyze the data And the data shows that the true advantage in modern investing is not about having exclusive access, it is simply about possessing the willingness to read. The number flashing on the screen today is undeniably loud, but it fades in a day. The calendar is completely quiet, but it runs the entire year. You must choose which one you will allow to make your financial decisions.